Roman credit crisis, 33 AD. In the year 33 AD, the Roman Empire had its first recession. The emperor demanded that banks repay all their loans in full immediately. This dried up credit overnight. Landowners went bankrupt, the property market collapsed, and the panic spread. Even Roman senators lost everything. It was the first recorded financial crash in history, and it all started because of too much debt. Panic of 1345. In medieval Europe, two giant banks in Florence collapsed after lending too much money to the English crown. They never got paid back, and when they failed, they triggered a massive chain reaction. Credit froze across the continent, merchants lost their businesses, and just a few years later, the Black Death hit. Europe's economy was already broken. The plague just finished the job. Spanish bankruptcies, 1557 to 1596. Despite mountains of gold from the Americas, Spain went bankrupt 4 times in just 40 years. It wasn't bad luck, it was war. Spain spent everything fighting in Europe and couldn't keep up with the bills. Inflation exploded, loans were defaulted, and the empire's economy began its long fall from dominance. You can't print your way out of a debt crisis, even with gold. Tulip Mania crash, 1637. The Dutch went wild for flowers. A single tulip bulb could sell for the price of a house. But then, the bubble popped. Prices collapsed overnight. Investors lost everything. The Dutch economy slowed down. And for the first time ever, the world learned what a speculative bubble really looks like. It was a flower-fueled recession. South Sea Bubble, 1720. Britain thought it had found the perfect company to erase its debt. It was called the South Sea Company. Everyone bought in, even the government. But the profits never existed. When the truth came out, the stock collapsed, people went broke, and the economy fell into chaos. Even Isaac Newton lost a fortune. He said, "I can calculate the motion of heavenly bodies, but not the madness of people." Mississippi Bubble, 1720. France had its own crash at the exact same time. The Mississippi Company promised untold riches from Louisiana. Stocks soared, people printed money to buy more, and it all collapsed just as fast. The economy broke, confidence in paper money vanished, and France didn't fully recover until decades later. It was a twin crash with Britain, and both learned the same painful lesson. Panic of 1797. War between Britain and France was heating up. People in London rushed to banks to withdraw gold. The Bank of England ran out. Panic spread. Banks collapsed, and unemployment spiked. The government was forced to suspend gold payments, and the public lost faith in money itself. The recession spread across the Atlantic and hit America too. Panic of 1819. The U.S. had just won the War of 1812, but peace didn't bring prosperity. Land speculation, bad banking, and falling exports triggered the country's first big economic crash. Banks failed, businesses went under, and Americans faced widespread foreclosures and poverty. The federal government did almost nothing to help, and the people never forgot it. Panic of 1837. President Andrew Jackson hated central banks, so he shut them down and demanded gold and silver only. It backfired. Banks collapsed, trade stopped, and unemployment surged to 25%. The recession lasted 7 years. It devastated the working class, and it showed what happens when financial systems change too fast. Panic of 1857. A booming economy met a sudden shock. Grain prices fell, a major bank failed, and the stock market panicked. Railroads collapsed, factories shut down, and unemployment soared, especially in the North. The South stayed mostly stable, but this economic divide would later become one of the causes of the Civil War. Long Depression, 1873 to 1896. One of the longest recessions in modern history. It started with a stock market crash in Vienna and then spread everywhere. Overbuilt railroads, failing banks, and falling prices led to decades of instability. In the US, workers protested. In Europe, businesses closed. And for nearly 23 years, the world economy struggled to find its footing. It made people fear that growth might be over. For good. Panic of 1893. 2 massive railroads collapsed. Then the stock market. Then the banks. In a matter of months, over 15,000 businesses shut down. Unemployment hit 18%. And people lined up for bread. This panic became one of the worst in U.S. history, and it turned public opinion against Wall Street and big finance. Panic of 1907. There was no Federal Reserve yet, so when banks in New York started failing, no one knew what to do. J.P. Morgan, the man, stepped in. He used his own money and influence to stop the collapse. It worked. But the panic proved one thing. The country needed a central bank, and just a few years later, it finally got one. Great Depression, 1929 to 1939. This was the big one. The stock market crashed, banks failed, farms dried up, and 1 in 4 Americans lost their job. Factories closed, soup kitchens opened, and hope disappeared. It wasn't just a U.S. crisis, it became global. Germany, Britain, France, Japan, everyone felt it. The Great Depression didn't just change the economy, it changed the world. Recession of 1945, World War II ended, and the military spending that fueled the economy vanished. Soldiers came home, factories closed, and jobs disappeared. It was a sharp, short recession, but the return to peacetime took a toll. Luckily, America bounced back quickly thanks to the baby boom, consumer spending, and post-war optimism. Recession of 1953. The Korean War had just ended, and with it, a wave of military spending disappeared overnight. Factories that made weapons started shutting down. Thousands of workers were laid off. Car production dropped. Steel and manufacturing took a hit. And for 10 straight months, the U.S. economy shrank. It wasn't catastrophic, but it was the first major recession of the Cold War era. A reminder that when wars end, so do paychecks. Oil Crisis Recession, 1973 to 75. In the 1970s, the global economy ran on oil. So when the Arab world stopped selling it to the West, everything stopped. Gas prices quadrupled. Lines at gas stations stretched for blocks. Inflation exploded. But so did unemployment. This was something new. Stagflation. When prices rise and growth dies. The U.S. fell into one of the deepest recessions since the Great Depression. And it taught the world one brutal lesson. If you can't power your economy, you can't run it. Early 1980s, double-dip recession inflation was out of control. The Fed had one weapon, interest rates, so they cranked them up to levels never seen before, and over 19%. Mortgage payments tripled, businesses stopped borrowing, and the economy tanked twice. Two back-to-back recessions crushed American industry. Unemployment hit nearly 11%. But in the end, it worked. Inflation cooled, and the economy was reset, ready for the boom years of the late 80s. Japanese asset bubble burst, 1991. Japan looked unstoppable. Its stock market was surging. Real estate prices in Tokyo were higher than New York, Paris, and London combined. But it was all a bubble. When it popped in the early 90s, trillions were wiped out. Banks were left holding toxic loans. Investors lost decades of savings. And Japan fell into what they now call the lost decade, a period of economic stagnation that haunted the country for over 20 years, and some argue it never truly ended. Asian financial crisis, 1997. It started in Thailand. Too much debt, too much speculation. When their currency collapsed, investors panicked and pulled out of Asia entirely. Indonesia fell next, then South Korea, then Malaysia. Entire economies lost 30 to 50% of their value in months. Banks shut down, crisis spread, and the International Monetary Fund had to step in with emergency loans. But not everyone was happy about that. The conditions were harsh, and for many countries, the recovery was slow and painful. Dot-com bubble burst, 2000 to 2001. Everyone wanted to be in tech, and investors didn't care about profits, only potential. Startups with no revenue were worth billions, until they weren't. When the bubble burst, the Nasdaq lost 78% of its value. Over $5 trillion vanished. Companies folded, jobs disappeared, and for the first time in a decade, the U.S. economy dipped into recession. It was short, but it exposed the risks of unchecked hype, and it set the stage for the next, even bigger crash. Global financial crisis, 2007 to 2009. This was the closest the world came to a second Great Depression. Banks gave out risky home loans to almost anyone. Then they bundled them into investments and sold them like gold. But when the housing market collapsed, it took everything with it. Lehman Brothers fell. AIG needed a bailout. Millions lost their homes. Unemployment spiked. The Dow Jones dropped over 50%. Governments across the world had to inject trillions just to keep the system alive. It changed the way people viewed capitalism, and no one who lived through it forgot how fragile everything really is. Eurozone debt crisis, 2010 to 2014. Greece admitted it had been lying about its debt, a lot. And suddenly the entire Eurozone was on edge. Portugal, Ireland, Italy, and Spain. They all looked vulnerable. Bond markets panicked. Interest rates soared. Unemployment in Greece and Spain passed 25%. Riots broke out, and the European Union was forced to bail out multiple countries. But the bailouts came with strings. Austerity. Less spending, fewer jobs, more cuts. For millions, the recovery felt worse than the recession itself. COVID-19, recession 2020. This wasn't a normal recession. This was a shutdown. Entire industries stopped overnight. Flights grounded, restaurants closed, tourism, entertainment, sports, gone. Unemployment in the U.S. hit 14.7% in just weeks, the highest since the Great Depression. The stock market crashed, governments around the world scrambled to inject stimulus, and central banks cut interest rates to zero. The economy bounced back quickly, but it came at a cost. Post-COVID inflation shock 2022 to 2023. Too much money, too little supply, and a global economy that was still recovering. Prices exploded, from gas to groceries to housing. Central banks responded the only way they could. They raised interest rates fast. Markets panicked, mortgages doubled, debt became expensive, and once again people started whispering that dreaded word, recession. It didn't fully happen, but for many it still felt like one. From emperors demanding silver to banks collapsing under bad bets, recessions have been crashing economies for centuries. Each one is different, but the pattern stays the same. Boom, bust, recover, repeat, and somewhere out there, the next one is already brewing.